After months of day after day red in the markets, my portfolio is finally up 12% over the past month, which puts it up well over 100% over the past 3 years. So in this video, I'm going to show you exactly what stocks I'm investing in right now, offer my thoughts on the stock market in general, and get into which stocks I think are going to perform the best going forward. So hit the like button if you want, and let's jump straight into my Charles Schwab portfolio. So in my portfolio here, you can see that we've selected the 1 month view, and that over the past month, my portfolio has increased by 12%, which is a reversal of what we've seen basically all year. If I change this to a 3-month view, we can see that since November, it's still down around 25% from its all-time highs, though its recovery more recently has been pretty nice. But while that 3-month view really doesn't look very good for the portfolio, it's important to keep things in perspective, because let's say we expand this out to a 1-year view. We can see that over a 1-year period, my portfolio is still up higher than it would have been if I just sat out of the market completely. And if I expand this to a 2-year view, it obviously has an extremely positive return. Now, this says that I made 300% over the past 2 years, when in reality it's closer to a 100% return, but Charles Schwab also counts money that you added into your portfolio over time as if it was a gain, so that's a little bit misleading. And you can see that between the beginning of 2020 and I guess the peak of the market in November 2021, we had quite a large run in the stock market before everything dropped pretty dramatically, basically for the beginning of 2022. And while I've made some previous videos talking about the continuing inflation and supply chain problems that we're going to probably see in the market, I have a lot of faith in the companies that I'm currently investing in and how they're going to perform going forward. So without further ado, let's start diving into those individual stocks. So if we scroll down here, we can see that the first stock in my portfolio, which is also the largest position, is Datadog, which I currently own 401 shares of at a market value of $66,000, and that's off a cost basis of $35,000. So it's nearly a 100% return in this company. Now, Datadog is a purely software company. They offer software to enterprises that lets them unite their security, their infrastructure, and their applications all through a single pane of glass, so they can view the analytics on all the data that they're producing in one place. This can unlock incredible value in corporations, and so they're willing to pay a lot of money for this kind of service. Additionally, with the continuing supply chain problems around the world, a pure software play like Datadog is somewhat resistant to those issues. So I think that this stock in particular may do well going forward. After Datadog, we have Cloudflare, which is my second largest position at 257 shares and at a market value of $28,000, which is off a cost basis of $16,000. So according to Charles Schwab, I'm up a little under 100%. But that's also partly due to how Charles Schwab calculates the gains that you get. They do it on a first in, first out basis. So I talked to you a couple months ago and told you I was selling some of my Cloudflare shares. And so the shares that I sold were actually the shares that I bought at the lowest price, which means all these shares remaining in my portfolio are the shares I bought at the highest price the most recently. And even on those shares, I have this kind of a return. So Cloudflare has been an excellent investment for me over the long run. Now, what Cloudflare does is try to make the internet itself work better. A few years ago, it would have been basically unheard of for any company besides Amazon, Microsoft, or Google to have any kind of sway in the cloud computing space. But Cloudflare has managed to build themselves up from just a DNS provider to a company that is actually starting to compete with the big cloud providers in terms of running the internet itself. This company is probably the most innovative in terms of the new products they keep pushing out. On their birthday every year, they announce a ton of new products, and their CEO, Matthew Prince, is one of the best in the business in my opinion, and he writes really great articles on Cloudflare's blog that I highly recommend you check out if you're investing in this company. Next up, we have CrowdStrike, which I have 149 shares of at a value of $27,000, and that's off a cost basis of $29,000. So in total, this stock is showing a loss for me. And again, that's because I sold some of my lower priced shares, so this is purely off the highest priced shares that I've bought. Now, CrowdStrike is a security company that offers cloud native security. For a long time, they were basically the only real competitor in this space, with most of their other competitors coming from the legacy security business. And so CrowdStrike was able to move much faster than them because they weren't bogged down by all their on-premise infrastructure and legacy products. Now, CrowdStrike has been growing very quickly over most of its lifespan, a lot of the time above 70% year-over-year revenue growth. Now, they've started to slow on that growth recently, especially with the size of the company just getting too big to maintain that kind of scale. And they're also starting to see some competition from other security companies like Sentinel One, which is a smaller cloud security company that is starting to grow even more quickly than CrowdStrike. Now, because of that, I have reduced the size of my CrowdStrike position substantially. In fact, this used to be my largest position overall, and now you can see it's my third largest position. That being said, I do still think this is a good company, and I'm going to maintain it as a position, just not as my largest position overall. After CrowdStrike, we have another security company called ZScaler. Now, ZScaler I own 60 shares of at a value of $16,900, and that's off a cost basis of $16,500, so it's just a little bit positive. Now, ZScaler offers zero trust security. So if you think of kind of a legacy idea of security, you might have one network that your entire business runs inside, and you make sure that no bad guys can get into the network, but everything inside the network kind of trusts each other. The problem is no network is 100% secure, and eventually a bad guy is going to get in. And with a legacy system, once they're in, they can basically do whatever they want. But what ZScaler does is allows you to set up a zero trust solution where every single application or computer on your network doesn't trust one another. They have to authenticate every single time. So if a bad guy breaks into one system, he can't get access to all your other systems automatically. This is kind of a core idea that's becoming more and more popular as more companies move into the cloud. Now, ZScaler has maintained really strong growth rates, and I've actually grown this position over time kind of in pace as I've decreased my CrowdStrike position. Now, these two companies are not direct competitors, but they do both touch on the security space. After ZScaler, we have Sentinel One, which I mentioned earlier. I currently own 274 shares of Sentinel One at a value of $12,000, and that's off an initial investment of $12,800. So it's down about $800, and this stock I really only bought into about a month ago. Sentinel One honestly does the exact same thing that CrowdStrike does. They offer cloud security to enterprises. The difference is Sentinel One is somewhat like CrowdStrike was 5 years ago. Now, no, they're not growing quite as quickly as CrowdStrike was back then, but they are growing more quickly than CrowdStrike is today, and they're obviously valued a lot lower because they're a much smaller company. Now, it's tempting to just say Sentinel One will be the next CrowdStrike and to get overly excited about this company, and I don't think that's necessarily a great comparison. I think Sentinel One is going to become a really good company over time, but they're going to do it by creating new products that don't already exist in the market, not by simply copying CrowdStrike's exact path. And I think that a lot of people who talk about this stock kind of miss that point. Now, I actually did a video comparing Sentinel One and CrowdStrike about a year ago, and in that video I talked about why I wasn't investing in the company, but since that time their growth rate has picked up substantially and they've become a much better company than they were, say, 6 months ago. And so I'm okay with having this as a mid-sized position now. Next up, we have ZoomInfo, which I own 194 shares of at a value of $10,800, and that's lost around $1,000 off the initial investment. Now, ZoomInfo is a company that when I first invested in it, a lot of people haven't heard of, but I'm guessing a lot more people have heard of them now. ZoomInfo makes it easy to get in contact with the people at companies that you need to communicate with, especially if you're in sales. So if you're on the sales side, you can actually reach out to people you need to connect with without knocking on doors, and if you're within a company, the people who reach out to you from the sales side are selling products that you actually want, because it throws out the old model of just hitting everybody with a sales pitch and really targeting it on the people who need the service. ZoomInfo is a mid-sized position for me. There haven't been any changes in this for a while, and I don't plan to make any changes anytime soon. After ZoomInfo, we have Upstart, which I own 77 shares of at a value of $8,000, and that's probably my biggest loser overall. It's off a $22,000 investment in total, so according to Schwab, I've lost almost $14,000. Now again, that is pretty inaccurate because I sold a huge amount of Upstart, I think around $20,000 worth a few months ago, a little bit before it hit its main crash. And so a lot of the money had already been taken off the table, and this represents some of the more expensive shares that I bought. Now you might be wondering, why am I holding this company that's lost this much money for me? And it has an F rating from Charles Schwab. Well, the main reason is because Upstart, more than any other company on this list, has been beaten down in the stock market really severely. Their price now is actually lower than it was in May of 2021. And I think that at some level that's not fair. The company's growth rate slowed dramatically from the amazing results they reported back in 2021 in one really exceptional quarter. But part of that is due to macroeconomic conditions, and the amount that the stock price dropped showed that the company had really gotten ahead of itself in terms of its stock price. I do think at its peak, Upstart was overvalued, and I did sell some of my shares after they reported pretty bad earnings around November of last year. But at this point, I think the company is dramatically undervalued compared to the value they're offering. Upstart offers AI-powered loans, replacing the traditional FICO score model where you just use one number to determine whether or not someone qualifies for a loan, and replacing that with thousands of different parameters that are all informed by an AI algorithm. This allows you to offer loans to more people who might not qualify for a traditional FICO score, as well as offer lower rates rates to people who are well qualified, which overall allows banks to make more money. Now, I don't know how long it's going to take for a stock like this to recover, especially with all the uncertainty around inflation, but I do believe that in the long term, this is going to be one of my best performing stocks. So I'm going to leave it as the size it is right now, and if it starts to accelerate growth again, I'll probably add money to it then. Now, moving out of my mid-sized positions into some of my smaller positions, next up we have C Limited, which I own 23 shares of at a value of $3,300, and that's lost around 50% of its initial value at $5,600. Now, C Limited, to dramatically oversimplify, is kind of like the Amazon of Southeast Asia. They have three main businesses. There's Garena, their video game business, there's Shopee, their e-commerce business, and there's C Money, which is their financial services business. Now, obviously, this company is struggling a lot with the current supply chain issues around the world because they don't have the same scale as a company like Amazon to basically create their own supply chain. And so any exposure they have to e-commerce is hurting them a lot, which is the main reason that I never made this one of my largest positions. That being said, the company has shown a great ability to basically understand the culture really well in a given country and then expand within that country and surrounding areas. They've done this in Southeast Asia, they've done this in Brazil, they're starting to do this in Mexico, and if they can keep up that pattern over time, this could grow into an absolute behemoth eventually. Now, right now, any kind of company involved in e-commerce that isn't an Amazon or an Alibaba is going to struggle, and that's probably going to continue getting worse as the supply chain issues worsen. So I'm definitely not adding money to this company right now, but I don't think I'm going to be selling any either, especially since it's already such a small position. After C Limited, we have Amplitude, which I own 65 shares of at a value of $2,800, and that's down around $400 off the initial amount that I invested in it. Now, Amplitude has been one of my worst performing stocks over the last 6 months. They're down around 50% from their high in November, but I'm currently filming this video on February 15th, so they're going to report earnings tomorrow, and based on the results of that earnings, I'm either going to sell out of this position completely or maybe buy back in if I think it's been beaten down unfairly. Now, the product that Amplitude offers I do think is a good one. They essentially make it so that you can optimize your product based on analytics. So let's say I have an app where there's a certain feature in the app where when people use it, they tend to spend twice as much as people who don't use that feature. In fact, the founders of Amplitude created that product because they were looking for a similar service for a different app they were trying to create, and when they didn't find a service that did what they wanted, they just created it and turned it into a company, which I think is a great idea. After Amplitude, we have SoFi, which I own 119 shares of, which is currently worth $1,500. So this stock has lost a little under 50%. Now, SoFi, I've talked about a ton on this channel, and recently they announced that they've been granted approval to complete their bank charter application, which means SoFi can now act as an actual bank for itself rather than needing to partner with a sponsor bank, which is what companies like Apple had to do when they launched their credit card with Goldman Sachs. Now, SoFi recently saw a brief surge in their stock price when they announced they were becoming a full bank, but in the video I made talking about that event, I told you that that surge in stock price would likely be temporary and that the stock would dip again before recovering in 2 or 3 quarters. And so far that seems to be true. The stock price rose for a day or two and then pretty much settled down even lower than it was before they made that announcement. And I think that's because that event was way overhyped because the actual acquiring of the bank charter was always going to happen, so it should have been baked into the stock price. But that being said, if SoFi follows a similar pattern to Lending Club when they obtained a bank charter, in 2 or 3 quarters, they should see a huge improvement in the fundamentals of their business, driven by all the money they save by not needing to partner with another bank. And this should show up directly in the company's earnings report, which in turn should lift the stock price. At least that's my theory. Finally, the smallest position I hold is a company called Affirm, which I own 14 shares of at a value of $600, and that's off an initial investment of $2,000. So it's dropped by, what, 75% since I've invested in it? So this may be my worst company overall. Now, Affirm offers a buy now, pay later service, where essentially someone can go on a website like, say, Peloton, and check out by using payment over time rather than having to pay all at once. This is a really popular service among millennials who are shown to be scared of credit cards, but I always had a problem with this company in that their product wasn't really helpful for consumers. As someone who's really interested in personal finance, I can't think of a single situation where I would use a buy now, pay later service, because you're just buying things that you can't afford with money money you don't have. Now, even though I've said that from the beginning, I still invested in this company because they had really good numbers in all their earnings reports, and it looked like they were growing over time and would continue to grow going forward. But at least so far, that's been a pretty bad investment overall. And while a lot of these companies do currently look like they're in the red, this is the only company where I really feel like I just made the wrong decision overall and I never should have bought in. So realistically, I'm going to sell Affirm at some point later this month. It's just not a company I have that much conviction behind, and even though they may do very well in the future, I'm okay with missing out on those gains for this particular company. Now, I have not made any trades in my portfolio for the past month. I'm still really confident in all the positions I already have despite the volatility, and so the only short-term trade I'm probably going to make is selling Affirm, and then there's a couple other companies that I'm still looking into that I'm going to talk about on this channel next month. So hopefully you didn't sell out of your portfolio last month and you're starting to see some green in your portfolio like I have this month. And make sure to subscribe so you can see how I'm doing next month and any changes I make in my portfolio between now and then, because I do think there are some pretty major changes coming. Don't forget to like and subscribe, and I'll see you next time.